Imagine a world where an entire nation's financial system collapses in just months, leaving people destitute and disillusioned. In 1720, Britain experienced one of history's most spectacular economic crashes, the South Sea Bubble. The year 1720 saw an economic phenomenon similar to today's speculative investment booms, such as the crypto craze. People believed they could rapidly accumulate wealth by investing in the South Sea Company, which promised lucrative trade with Spanish colonies despite having no tangible assets or earnings. This company quickly became a sensation in London's financial circles. So how did it start? Well, at first, everyone thought the South Sea Company was the next big thing. In 1720, the company's stock price skyrocketed from £128 to over £1,000 in just a matter of months. People were buying shares left and right, even those who couldn't afford it. But here's a key detail: the South Sea Company didn't engage in actual trade. It was all based on speculation. They had no real trading activities or significant assets, but managed to convince people that they would become wealthy through their promises and stock sales. Now let's dive into the mechanics of how this happened. In 1720, the British government needed money badly, so it struck a deal with the South Sea Company. If the company took over Britain's national debt, the government would give them exclusive trading rights and other incentives. Sounds like a win-win on paper, but things quickly went wrong. Subject: the South Sea Bubble. Britain's spectacular financial collapse of 1720, the South Sea Company did not have the cash to take on this massive debt. Instead, they offered shares in exchange for deposits from investors. As more people invested, the company used their money to buy back its own shares, driving up prices artificially. This is where greed and misinformation took over. Brokers were pushing stocks relentlessly, promising huge returns. People were borrowing money to invest, believing it would yield substantial profits. But here's the kicker: the actual value of those companies was far lower than their inflated stock prices. Now let's look at some numbers. In just a few months in 1720, the South Sea Company's stock price soared from £128 to over £1,036 per share. That might sound impressive, but it wasn't based on any real value or earnings. The company was like a Ponzi scheme on steroids. By late summer of 1720, the South Sea Bubble started to burst. As soon as people realized there were no actual profits coming in from the company's ventures, they began selling off their shares. Prices dropped sharply and rapidly. People who had borrowed money to invest often found themselves unable to repay their debts, leading to significant personal financial losses. Even those who did not borrow money still suffered substantial declines in wealth. One example: John Blunt, a wealthy merchant, invested £10,000 into the South Sea Company. By year's end, its value had plummeted to just £500. This demonstrates the severe losses investors faced during this period. The government attempted to intervene but could not halt the panic selling. It passed legislation to prevent the spread of false information regarding stocks, but these measures came too late to reverse the damage that had already occurred. Now let's talk about the aftermath. By the end of 1720, many Britons were financially ruined and disillusioned. People lost their life savings overnight. Many committed suicide due to shame and despair. It's a stark reminder that financial bubbles don't last forever and crashes can be devastating. So how did people react? They demanded answers and pushed for reforms. As a result, the directors of the South Sea Company were removed from their positions, and several prominent individuals faced legal consequences. Numerous lawsuits and investigations followed as people sought to comprehend the circumstances that led to the financial collapse. The real lesson here is that bubbles aren't just financial phenomena, they're also social ones. In 1720, many people invested enthusiastically due to exaggerated claims about quick wealth, while those who remained skeptical or cautious fared better in the long run. Another key point: the South Sea Company's collapse in 1720 highlighted the dangers of unregulated markets and investor overconfidence. While modern financial regulations aim to mitigate excessive market volatility, human greed continues to influence investor behavior. Now let's talk about a concrete number that shows how much wealth was lost. £1 million, equivalent to many billions today when adjusted for inflation, was wiped out in just months. That's like losing the GDP of a small country overnight. Imagine if your city suddenly lost all its revenue and jobs due to an economic collapse. The impact was immense. The South Sea Bubble is also important because it showed how quickly public opinion can change when reality sets in. In 1720, people were buying stocks with borrowed money, convinced that they would become wealthy overnight. But by the end of the year, many were selling their assets to cover substantial losses. It's a classic example of boom and bust cycles. Another lesson is about the power of misinformation. In 1720, during the South Sea Bubble, brokers and company insiders spread false rumors to inflate stock prices artificially. When people discovered these claims were untrue, investor trust vanished overnight. This highlights how crucial it is to verify information before investing. So let's sum up what happened. The South Sea Company's stock price jumped from £128 in early 1720 to over £1,000 by summer. But once the bubble burst, prices plummeted back to around £100 by year-end. People who had invested lost fortunes overnight. Now here's a surprising fact. The South Sea Company's stock price didn't recover for decades after the crash, taking until around 1742 to regain some stability and trust from investors. It's like if you bought stocks today and saw no gains for over 2 decades. That's how long it took to rebuild trust in financial markets following such a spectacular collapse. This period also led to stricter regulations, which helped stabilize future financial markets. Laws were passed to prevent companies from issuing false or misleading information about their value, helping to curb fraudulent practices and protect investors. These regulations laid the foundation for modern consumer protection laws and transparency requirements in finance. Another aspect to consider is that the South Sea bubble highlighted extreme wealth inequality. Early investors reaped enormous profits, while those who entered later often suffered significant losses. This dynamic mirrors modern financial trends where a small number of individuals can experience substantial gains at the expense of many others. The impact on everyday life was severe. People struggled to pay their bills, businesses faced bankruptcy, and employment opportunities vanished abruptly. Imagine waking up one day to find that your livelihood has disappeared because of a financial crisis. That's what occurred in Britain during the South Sea bubble of 1720. So let's look at how people dealt with this crisis. Some turned to government aid, others found new work, but many struggled for years afterward. This highlights the importance of having savings and a financial plan during uncertain economic times. Subject: the South Sea bubble. Britain's spectacular financial collapse of 1720. Now, consider the long-term impacts. The South Sea bubble altered Britain's economic landscape permanently. People became more cautious with investments and demanded greater transparency from companies and regulators. This led to increased oversight and the development of regulations that protected investors in subsequent decades. Subject: the South Sea bubble. Britain's spectacular financial collapse of 1720. In short, the South Sea bubble was a disaster that taught hard lessons. It demonstrated how easily people can be misled by greed and false promises. This event also spurred changes that made financial markets safer for everyone. Now let's recap what we learned. Greed drives financial bubbles. Proper regulation can help prevent market excesses. Misinformation can lead to poor investment decisions. Diversification can reduce risk in a portfolio. The South Sea bubble reminds us that financial manias and speculative bubbles are recurrent phenomena in economic history. Just as seen in modern times with the cryptocurrency craze or the dot-com boom of the late 1990s, individuals frequently pursue rapid gains through speculative investments, but often find themselves suffering significant losses. So what can we take away from this? Be skeptical of claims that seem too good to be true and always conduct thorough research before investing. Stick to well-established investment principles and diversify your portfolio. Never risk more than you're prepared to lose. Remember, history teaches us to stay cautious, not fearful. The South Sea bubble of 1720 is a cautionary tale about the dangers of financial speculation and the importance of regulatory oversight. This is educational and historical, not financial advice. The South Sea Company began as a speculative bubble fueled by promises of vast profits from trading with Spanish colonies in South America. Investors were told they would benefit greatly from this trade, but what many did not realize was that the company lacked ships and had minimal real assets to support these claims. As shares skyrocketed, ordinary people rushed to buy into the hype. Even those who could not afford it sold their possessions and mortgaged their homes to invest. This situation is reminiscent of speculative bubbles seen in modern times, where promises of instant wealth drive investors to purchase securities instead of traditional lottery tickets or other forms of speculation. But as often happens with bubbles, reality eventually catches up. When the South Sea Company failed to meet its promised returns, investors began selling their shares in large numbers. This led to a market crash that left many individuals financially devastated. This crash was devastating for Britain's economy at the time. Many banks failed, numerous businesses closed, and thousands of families suffered financial ruin. Recovery from this economic crisis took decades. The British government eventually responded to the South Sea bubble crisis with new financial regulations aimed at preventing similar speculative bubbles in the future. This period highlighted how unchecked speculation and greed could lead to severe economic consequences. Today we see echoes of the South Sea bubble in our modern markets. Historical instances like this remind us that people can get caught up in speculative investment frenzies, whether it's cryptomanias or other high-risk investments promising quick profits. It's important to understand that such opportunities often carry significant risks and may not deliver on their promises. Understanding historical events like the South Sea Bubble of 1720 highlights the importance of conducting thorough research and adhering to well-established investment strategies. Diversifying your portfolio helps spread risk, and it's crucial not to invest more than you can afford to lose. Stay informed and cautious, but avoid making decisions driven solely by fear. This is educational and historical, not financial advice. In 1720, the South Sea Bubble demonstrated how easily people could be swayed by false promises of wealth. Imagine if someone today offered you a chance to become instantly rich with no real work or risk involved. You'd likely be skeptical, but back then many investors fell for these schemes hook, line, and sinker. The bubble's collapse was severe. People lost their life savings as stock prices plunged dramatically. Many were left impoverished, compelled to sell off assets simply to survive. It took several years of hard work and significant economic reforms to restore confidence in the financial system. Today, we see similar patterns with cryptocurrencies promising easy riches. But history teaches us that such get-rich-quick schemes rarely end well. In 1720, the South Sea Company promised investors high returns, which seemed generous but were unrealistic given the company's actual assets and revenues. Modern investors need to be wary of overly optimistic forecasts or promises of guaranteed profits. It's crucial to ask critical questions such as, how does this business actually generate revenue? What potential risks does it face? Is there a contingency plan in place for when things do not go according to plan? Stay informed, do your research, and don't rush into any investment without fully understanding its risks. Remember, simple investments like index funds often quietly outperform flashy get-rich-quick schemes over time. This is educational and historical, not financial advice.